Hello, my name's Tim Gregory. I'm from Vermeer Investment Management in London, and I hope everyone is doing okay, managing to stay safe, and friends and family are all doing okay at this extraordinary time. Today, after such a good recovery in stock markets in recent weeks, I thought we might try to focus a little bit on valuations. Now, as we all know, we have seen unprecedented cuts in interest rates over recent years, and of course again in recent months to help the economy. Unprecedented amounts of money supply coming into the economy provided by the central banks and governments in order to keep economies going at this extraordinarily difficult time. And this has helped buoy stock markets to recover strongly at the same time as the economy in the second quarter has almost totally collapsed to unprecedented levels of weakness that we've rarely seen before. And in some respects, that renders 2020 in terms of trying to price equities as almost a write-off. I don't think it's worth dwelling too much on what earnings are going to be in 2020. Stock markets are already, as they often do, looking beyond that. So we need to try and focus on what earnings might be in 2021 and even beyond that. And it's really hard to make any sensible assessment of what valuations might actually be. But if you take the 2019 earnings for the S&P 500 of around $167, and if you assume a recovery to 80 or 90% as economies bounce back in 2021 from the dislocation that we've seen in 20, that may get earnings back to around $140, $150. And actually, given that markets have rallied to above 3,000, that puts equities on a forward multiple to 2021 of above 20 times. Now, you might think, my goodness me, that is historically very, very high for markets. And indeed it is. And a lot of stocks, particularly in the technology area, are on even higher multiples than that, reflecting growth in new technology areas that have managed to hold up so well in this difficult time. But the fact is, interest rates are very low, almost zero. Bond yields around the world in some places are in negative territory, and in the US they're only marginally positive. And this enables investors to pay higher prices for equities, given the comparative value that they see in other asset classes. Now, how long this continue, I think really depends on the delivery of earnings. We simply cannot know what earnings are going to be, what the scale of recovery, what a normalised economy might look like post the COVID pandemic if we can get through without another major wave locking down the economies again. We simply can't tell yet what earnings are going to look like. But it is going to be, therefore, the case that companies are going to have to continue to deliver good results and execute on their strategies to justify the higher valuations that we are now paying for equities and feeling reasonably comfortable with because bond yields and interest rates are so low. So much is undecided at this point, but these, I believe, are the things that we should be looking at as we move into the second half of 2020 and into 2021. The key is that whilst we don't know what earnings can be, is that the companies that we invest in execute successfully on their strategy going forward. Thanks very much for your time today. Stay safe.